Investor. We're talking real money.
There is something that we rarely ever do on the Talking Real Money podcast, and that is invite guests. There's a reason. Most of the people in the financial media and the financial services industry, for that matter, don't give a damn about you. They care about them, and they come on these programs to primarily promote them and not help you. However, we occasionally have some great guests, people who have proven their commitment to investors and educating investors. And there are only a handful of those people, in my opinion. One of those people is someone with whom we have worked with for many years, highly respect. He's out there educating everybody all the time. Don't know how he does it all. Writes books like they're going out of style. And we love spending a little time talking with Dan Solin. Hi, Dan.
So, Don, I'm thrilled to be here. Especially after that introduction, I'm really honored to be chosen as a guest. On the flip side, though, I don't know if I can live up to that introduction. So,
by the way,
I'll absolutely do my best.
We'll be the judges.
Yeah,
of that.
That's an easy measure. By the way, the other reason we don't have guests is there's two huge egos. There's a limited amount of oxygen. I mean, how much can you pump in to keep the whole thing running? So,
and that's why we do. That's why we do it. That's why we do it virtually, because exactly. we don't occupy the exact same physical space.
Yeah, wouldn't work. So, Dan,
my ego at the door.
Good for you, because you'll do better according to your own book. Dan's written a new book. It's called Wealthier, the Investing Field Guide for Millennials, which I read. Here's the interesting thing for us and millennials. Now, most of the people that we're talking to today are older than that, right?
Boomers. We're the boomers.
Yep. But most of the people that I work with are the millennials. So I get the feedback face to face, and I'm always fascinated to ask them what they're thinking about, what the worries. And here's the number one and number two issues. Number one, why can't I buy a home? Number two, I worry eventually that my retirement won't look like your retirement, Tom, because things aren't going well.
You've used up all the money, Tom.
Exactly. So, but let's start with because you have a chapter on this, buying versus renting. Now, there's all kinds of work out there that says today, I guess if they're to be believed, it makes more sense to rent rather than buy because home prices are high and interest rates are high. But what do you tell millennials about this whole conundrum of trying to make a decision here and make a good financial decision?
So back to your point about most of the listeners being older than millennials, one thing to keep in mind is those people, including your clients, they have millennials in their family that they love and cherish, and they want to have those millennials get on the right path in life at a very early age. So I think that's critically important that they help them do that. And one of the first questions that they will be asked is what you just asked me, Tom: should I buy or rent? And here's taking kind of a view from a very elevated view of like long-term, what's in your best interest. I know there's a lot of discussion about the issues you raised, Tom, like, houses are very expensive, interest rates are very high, difficult to get mortgages, hard to save up for the down payment. I understand why millennials cannot break into this housing market. But what I'm saying is in most, but not all areas of the country where housing prices are not completely crazy, like San Francisco, Silicon Valley, those areas, if you want to end up with more money for retirement, the data is very clear that people who own a home end up with a higher net worth than people who rent. And it isn't because the home appreciates more than they could earn in the stock market. It really just comes back to forced savings. When you have a home, you are forced to pay that mortgage every month. Yes, you would do better historically if you invested in the S&P 500, but you won't. You'll spend that money. So my advice to millennials is, I know it's hard, but if you can possibly break in, even in a modest way, to the housing market, it's a very worthy goal.
So it all boils down really to our psyches working against us. Because if you were to rent a home and pay even the same amount you're paying for a house per month out of your pocket, because you don't have some of that money going to principal to an investment, you're going to end up with more money. But if there was a way, and I'm not in a magical world, if there was a way to force savings for investments, would not those millennials be better off?
They would be.
And that's a question, by the way, that comes to lead to our next topic. We're talking with Dan Solin here on Talking Real Money. The 401k. So New York Times piece today says that the 401k is out of date. It's unfair, especially to lower income workers. And we've transferred, sort of the retirement responsibility, if you will, from companies to individuals. At one point, they called the experiment of self-directed retirement financing over as a failure. But it is the system today. So for millennials getting started, what's your general advice on how to start, how to pick the funds, how to just figure this whole thing out?
So I'm well aware of the deficiencies of 401k plans, and I'm not here to say that they're a panacea, but especially if your employer matches, I recommend that you contribute at least the minimum necessary to your 401k plan to get the maximum to get the maximum match from your employer. Now, having said that, there are lots of issues with particularly smaller 401k plans. They tend to have high costs and expensive investment options. Like I'd love to see a 401k plan that had all index funds as options, but there are very few that do. So look at the expense ratio, the management fee, and to make life simple, consider a target date fund. If the expense ratio is, say, 50 or below, 50 basis points, a half of 1% or below, and you could put all your contributions in a target date fund. Other issues with 401ks are, should you invest when you invest in a 401k, when you start taking money out, you're going to have to that money is going to be taxed at your marginal tax rate. What almost nobody will tell you is, no matter how smart your financial advisor, they can't predict your marginal tax rate when you go to take it out. So you're going to take a hit. If you have an option for a Roth 401k, you could consider doing that and sacrifice the immediate tax benefit for the long-term tax advantage of taking that money out tax-free. So that, in a nutshell, that's my view on 401ks.
What about, though, because the key to enjoying a great retirement is getting started early. It's investing now, which is hard for millennials. Heck, it was hard for us as baby boomers early on to do. What is the best way, particularly for those who don't have a 401k option at work, to start saving or to force themselves to save and invest early as opposed to waiting until I have the money?
So I call it kind of like savings shaming. I mean, what happens with millennials is everybody says, look, given the power of compounding, which is astounding, right? Small amounts of money over long periods of time turn into large amounts of money because you're getting interest on interest. So obviously, you're right, Don, that if millennials could start saving early, that would be great because that money works longer and they're going to build up a lot of money. It's just not practical advice. I mean, we're talking about young people who get out of school with often six-figure debt. They've often just gotten married. They're trying to plan a family. They're trying to save for a house. They have high credit card debt. It isn't realistic to say to these people, I want you to save 15 to 20% of your gross income and still meet all these other obligations. So instead of telling them, oh, do that or you're a failure. I mean, if you can do that, obviously it's great. Yeah. But many millennials
but it's those who can't.
For those
what do they do?
They do something called consumer smoothing, which is a sophisticated way of saying, while you're young, accept the fact that you're going to have debt, try to live within your means, in fact, below your means, admit that you just can't save as much as you should be able, as you'd hope to save. But as your career progresses, continue to live below your means. And when you start making more money, put more money away so it looks like a bell-shaped curve. Just accept that you're not going to save a lot when you're really young and just starting, but have loftier goals as you make more money. What happens to most people is they get traded up in life. They make more money, they buy a fancier car, they move to a nicer home, they go out to eat more often. If you want to engage in consumer smoothing, you have to maintain your style of living and leave room for larger savings during your peak earnings years.
And what about a rounding service like an Acorns or something like that, where it doesn't require any saving really at all? You're still spending money, but part of it just gets put away into a Roth IRA, for example.
I think they're brilliant. I think it's a brilliant idea, and because it's what tends to work. There's a difference between advice that works and advice that's practical. What doesn't work is making people feel badly because they're not saving enough. What does work is any element of forced savings that you don't even have to think about. So I love Acorn. I think it's a wonderful app.
Well, then, speaking of forced savings, we're seeing some trends in Washington and in the States towards at least a default withdrawal from paycheck plans, that even those, Washington State just passed a law, even those who do not have 401ks or 403bs at work can set up an account and it can be taken out of the paycheck, as opposed to requiring someone write a check every month. Is that part of a solution to the problem of savings? And are there others that might come down the pike that would help?
Well, we know that the present system is not working when we look at the amount of money that the average retiree has saved for retirement. We know that they're going to run out of money. So the current system, which relies on voluntary contributions and prudent investing behavior, we know that doesn't work. So I happen to think that what you're saying Washington State did, I think those are great ideas, because again, they make it automatic. And we tend not to think about stuff like that. So I think that works. There's a lot of data from other countries like New Zealand, and I think some countries in Latin America that have
Australia with their super attenuation.
Exactly. And that also gets around the poor investing. We have to deal with, okay, we're going to force you to save, but how are we going to invest that money? And that becomes a very important issue, because the interest of the securities industry is very different from the best interest of the employee.
Not surprisingly at all. We're talking with Dan Solin, who's, of course, a best-selling author from the New York Times. By the way, you wrote a book with the name, the word sales in it. Do you get crap for saying the best-selling book? I mean, because people, that's such a negative connotation. Like, I don't want to be sold anything. I want to think I'm really smart and bought that. Do people say, I don't want to, Dan, quit telling me about how people should sell me? How's that all worked out for you? Okay.
Well, so there are two things. I think authors love it. We do have an ego. So when our book makes the New York Times bestseller list, and I was fortunate to have 2 books on that list, that gives you some credibility. So of course we slap that on the cover of every book subsequently that we write. And so that people, when they look at the cover, will say, oh, this must be something here. He was a New York Times bestseller. Turns out, it's not that hard to get on the New York Times bestseller list. You don't have to sell that many books, but nevertheless, so that's how that works. But you're right. People don't like to be sold anything, and advisors like you and Don don't sell. You basically present, you do exactly what should be done. You respect the intelligence of the people you're talking to, even on this podcast, right? You lay out facts and you leave it to them to connect the dots. And that's not selling, that's really helping people, but it's a form of sales.
Now, we were talking about this just before Tom's question about selling, and that is the way we all invest in our particular plans at work, 401ks, 403s, 457s. But even in our own IRAs, brokerage accounts, and the like, and that is the incentives to sell. Speaking of selling, on the part of the industry, and most of the industry it's been shown don't always act as fiduciaries. What do you think will be the impact of this new Department of Labor rule that supposedly requires anyone who gives advice on qualified assets or the rollover or transfer of those assets always act in a fiduciary best interest capacity?
I unfortunately don't think it's going to have much of an impact at all. And I don't even think that advisors, RIAs who are fiduciaries, I don't think you and Tom would act any differently towards your clients if you weren't legally obligated to be fiduciaries. I think your ethical kind of barometer would always cause you to act in the best interest of your clients and to disclose any conflicts of interest. If that's not part of your ethical makeup, the government can do whatever it wants. It can make you say I'm a fiduciary or not. I see ads all the time for fiduciaries who I know aren't. And so I think people are clever and they're always going to find a way around it. And then the law has to get involved and interpret, was your contact consistent or not?
Then what is the solution to the problem that over 90% of advisors, and there have been multiple studies that have shown this, are not always acting in their client's best interest when in fact the clients believe they are? What can we do to help those poor people who are being given this horrific advice?
I wish I had a good answer to that.
Read
question.
Dan's book. I mean, come on, here you go.
Problem.
That's easy, right?
I mean, it's amazing to me that so many disreputable people are in the business of offering financial advice. It's actually very difficult to find people like the two of you. I don't say that because I'm on your show. I mean, I've known you for years. And it's very difficult. I know hundreds of advisors, and maybe there are 10 who I would give my own money to, right? So it's such a good question, Don. I don't think the answer is looking at the advisor saying, will you sign this fiduciary pledge? I mean, nobody has to make you sign a pledge to be honest and forthright. You either have it or you don't have it. And so I think the kind of due diligence that has to be done is you have to rely on people you really trust and hope that they're going to put you in touch with an advisor. I mean, all of your readers and listeners can contact me. I'll be happy to give them a list of advisors who, whatever they're called, will act in their best interest and will do right by them. But it's not easy to find them.
No, it's not easy. Okay, the book says investing in it. We haven't talked about investing yet. I mean, this is because saving is one thing, right? You know, sort of, and I personally think it's got to be an automated because people otherwise just have too difficult times, as you said, sort of peeling back something than instead of going out for dinner, I'm going to fund my retirement. But okay, to the investing side, can millennials, it feels like there's so much information out there. How do they wind their way through TikTok or whatever source? And we did a piece not long ago about the number of millennials who use very, I think, places to get their information about investing. They're not doing them anything right. But where do they go for that? And truly, can people just pick a couple of index funds, get on with their life, especially when they're in the kind of the accumulation phase of their lives?
So this is my 7th book on investing. I'll tell you what I've learned from doing the research for those books. I'll tell you exactly how I invest my wife's and my money. I have, our asset allocation is 40-60, meaning 60% of our investments is in bonds, 40% is in stocks. Asset allocation refers to the division of your portfolio between stocks and bonds, and everybody's is different, and it largely depends on your age. Higher allocation to stocks is riskier in the short term, but over the long term has what's known as higher expected returns. Higher allocation to bonds is a less bumpy ride. So we use 2 ETFs. One is the Vanguard Total Markets Fund. Total Stock Market Fund, VT. We own a little piece of the world stock market. and the other is a short-term treasury bond fund. The short-term treasury bond fund has only like very short-term treasury bonds. It historically has not paid a lot, but currently it's doing great. I mean, it's pushing 5%. But we don't use our bonds to generate yield. We use it to mitigate the volatility of our portfolio. I don't want to sound arrogant, but if that is good enough for us, it's probably good enough for millennials who don't have our assets. So in the book, I make it very clear that VT and I recommend a bond fund called SHY, but there are many short-term treasury bond funds. You're not going to take any risk with that. Investing is not complicated. It is made to be complicated because a lot of people have a vested interest in saying, oh, investing is much too complicated for you. So to Don's earlier question, there are every day new products coming out with all kinds of esoteric twists, shiny objects, and people rushing to buy them and being confused. But if you just bought those 2 ETFs and held them your whole life, you'd be in great shape.
Well, and that goes back to the question about financial advisors. In reality, and we say this, we are financial advisors. Our living is made providing advice to people for a fee. But we have been saying, and I've said my entire career, particularly when you're younger, just getting a simple portfolio with the right asset allocation is good enough. You can't do a lot better. So in that case, do most millennials even need an advisor?
They don't. They really don't. And it doesn't make sense for them to use an advisor. I mean, it depends upon how the advisor charges, what their assets are. But take a
yeah, but in most cases, they're going to get an Ed Jones guy or an Ameriprise woman, or they're going to get somebody from their local brokerage firm providing advice. They don't need those people.
What could possibly go wrong with that? So we know
a lifetime of overpaying. Yes, that would be great.
We know that trouble is brewing. I mean, buy 2. How hard is this? If buying 2 ETFs is too hard, buy a Vanguard target date fund that is close to your date that you're going to retire. Put all your money in that. Don't give it a thought. We talked earlier about how the mind
put us out of business.
No, only
we're going to come to work for you, Dan.
But see, millennials are not your client base.
No. I was being facetious. I want to put us out of business, at least in that regard.
Well, people listen to this podcast are going to be off to a very good start, right? We're demystifying investing for them. We're saying, look, basic investing is really quite simple. The problem is us. It's not the investing. The problem is the desire to confuse activity with progress and not to understand that with investing, the less you do, the more you're likely to earn. Don't look at your portfolio. Don't watch the financial news. Don't pay attention to anything. Just get your asset, as you said, Don, get your asset allocation right. Buy a target date fund or a couple of ETFs. Go live your life, play golf, have fun. Time is much better spent doing that. You'll be fine.
Basically, Wall Street lives by W.C. Fields' adage: if you can't dazzle them with brilliance, baffle them with BS.
Absolutely. It's worked. The book is Wealthier, the Investing Field Guide for Millennials. Before we let you go, I got to ask, because this week we learned that the Social Security system, if you will, got another year. It's going to work for another 10 years before. And got to be careful how we say that. It's not going to run out of money. Less money is going to come in that's being paid out under the current status. So here you are. You get to jump on your soapbox and tell us, how would you fix this? What is your solution to fixing Social Security?
He doesn't have solutions. He already said that.
Oh, I see. He's not a predictor. Okay, that's too bad. Thanks, Dan.
I'm not a predictor. I mean, that's a very complicated problem. It's a national disgrace what's happening with Social Security. And I think some of the solutions that have, and don't take me too seriously, I haven't examined all possible solutions to the Social Security problem. As a practical matter, and I could easily be wrong, politically, I just can't imagine even our dysfunctional government letting Social Security go under, because a large percentage of retirees rely on Social Security for the majority of their sustenance in retirement. So
it's
this would
25%, 90, that 25% of retirees, 90% of their income comes from Social Security. So
a devastating statistic,
Yeah,
right?
that would
And
be
the average Social Security check is around $1,500 a month.
not
or something,
big.
right? I mean, so devastating. But I would say investing Social Security the way we just talked about responsible individuals investing, like if the government came to the two of you and said, we've got this fund, it's called a Social Security fund, it has to last forever, so think of it like a big pension fund, how do you think it should be invested? It wouldn't take
VT
you
in a
long.
short-term bond fund.
You'd put it in a, you
And
put
VT in a short-term bond fund.
exactly.
Pretty easy. Yeah.
That's what you would do.
Yes.
And that would solve our problem.
Oh, it's a mess.
Your lips to God's ear. I mean,
Exactly.
love to see it.
Dan, this has been fun. Thank you again for joining us.
Thank
And
you so
what's
much
the
for
name of the
having
new
me.
book again?
I've
It's
got it right here.
Wealthier.
I got
I
it.
want him say it.
Okay, go ahead, Dan.
Wealthier, the investing field guide for millennials.
I
Is this
enjoyed
for
it.
available in
millennials
English.
going out and hunting
The
baby
field
boomers?
guide, yes.
Yeah.
It's kind of a guide to help
It's-
them
it's-
hunt for financial freedom.
And it's
Oh,
written-
okay.
I love the way it's written. It's written a little like your book, Don. It's just very straightforward. Here's the point. Here's what you need to know about it. It's simple to understand. And I think, honestly, for any millennial, it's not going to take them that much time to read it. Or, by the way, it could just be, as you said, a field guide. So when something comes up, there's your guide. It's right there ready to be reviewed.
Because it's so simple, financial books should never be thick. Ever.
Yes, true. Well, it's hard. The investing piece is simple. The psychology is not so simple. I mean, dealing with that is challenging. I love serving the underserved. So millennials are underserved because advisors really don't want their business. They don't have enough money to make it profitable. Hispanics, Spanish-speaking Americans are underserved. So we're putting out the book in Spanish at the same time.
Good for you.
And we're making the website accessible in Spanish. So I hope it'll make an impact. I hope it'll help a lot of people. Nothing gives me more pleasure than getting emails from people say, I bought your book 10 years ago and now I can retire. And I'm sure you have the same experience.
Indeed, we do.
With your clients. It's very rewarding. So thank you both very much.
Thank you, Dan. We appreciate it. Dan Solin, check out all of his books. He is a prolific writer. And Dan, have a great rest of your week. Take care.
Thank you, Don.
I'm Don. Tom's over there in Seattle. Dan's going away. He's down in Florida. You're in Florida?
Yes.
Yeah. Okay. 2 in Florida. You lose, Tom.
It's 2-1. I guess I got to go instead.
We all spend a lot of our lives doing this really important thing, and that is talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.